Good morning. Thank you all for having me today. I really appreciate the opportunity. I'm here upon the referral of Supervisor Cottrell at a prior meeting of your board to provide an overview of changes to the regulatory environment of California's property insurance market since late 2023. I should note from the outset that this overview is primarily focused on Napa-specific impacts and targets. We could talk for a long time about the intricacies of the regulatory changes, but what really matters to our public is how it will affect them and what this board can do to prepare for those changes. Members of the public interested in further discussion may contact me at the email address included in the concluding slide of this presentation. And those slides will be posted following the meeting on the county's agenda website. Attach the item on today's agenda corresponding to this presentation. Let's talk first about the state of play. These regulatory changes are happening because California's property insurance market is at or near a tipping point. The top 12 property insurers in California represent 85% of the total market, and 7 of the 12 have paused or restricted new business since 2022. In addition, hundreds of thousands of property owners from Brentwood to Mount Shasta have received notices of non-renewal. This is because of heavy losses sustained by insurers in California's market over the past 5 to 10 years. There are 3 main causes of these losses. Wildfires are more destructive because of more extreme heat and wind, and due to new development outside existing urban cores. The second, insurers in California presently lack the ability to use forward-looking models to justify their rates to the California Department of Insurance. And finally, insurers lack the ability to factor in the rising costs of their own insurance policies from global firms. This is a process known as reinsurance. The Department of Insurance can't really address the impacts of climate change, but it can address the latter two. So that's what we'll be talking about today. Separately, but relatedly, the state-mandated Fair Access to Insurance Requirements Plan, or we'll call it the FAIR Plan from here on out, an insurer-funded plan of last resort that offers more limited coverage and is not subject to the same pricing regulations as standard insurance, has grown statewide from 154,000 policyholders in 2019 to 408,000 5 years later in 2024. The FAIR Plan currently, as a result, has approximately $393 billion in exposure and has just $200 million in reserves. This makes insolvency not just possible but likely in the event of a big disaster that affects a significant number of FAIR Plan policyholders. So a thesis, I think, would be these regulatory changes are going to present Napa County an opportunity to create additional return on its investment in wildfire mitigation. Let's talk today about how we can achieve that return on investment. Okay, I'm going to talk very briefly about a few key terms. Insurers undertake 2 interrelated processes in conducting business. They do underwriting, which is the decisions they're making about coverage based on past localized losses on a parcel and forecasted future risk. They're using a few different models to determine this future risk. Underwriting is not currently regulated by the Department of Insurance. Rate making, meanwhile, is the process of insurers applying to the Department of Insurance to set rates they can charge for coverage. Only past losses can be used as justification for these changes. This is what the current regulatory proposal seeks to address. The process of forecasting future risk is known as catastrophe modeling. This is a probabilistic forecasting that runs thousands of simulations on a particular area, on a particular parcel, to determine how a disaster might affect it. Use of catastrophe modeling is currently permitted in 49 of 50 states. In California, because we don't allow catastrophe modeling, there's asymmetry between what investors are allowed to use to set their rates before the California Department of Insurance and what they actually use in making coverage decisions. Their models are telling them there's substantial risk associated with a coverage of a parcel based on future risk, but they're not allowed to take that into account when they go before the insurance commissioner and say, this is what we'd like to charge. It creates a scenario for them where they're unable to find a balance in their profit-seeking venture. Their response has been to cut their books down to a size that they find sustainable over the long term, and that minimizes the risk of insolvency, given the artificially low rates that they can actually get approved. Property owners, meanwhile, have two options once they've been cut from that book of business. They can go to the FAIR Plan, which hundreds of thousands of them have done, or they can get better coverage through surplus line carriers, but that coverage lacks the regulatory backstop that the admitted market has and that the FAIR Plan has. It's two not very good options. So let's talk about what the insurance commissioner can do. The first and primary vehicle for fixing California's insurance market is the state insurance commissioner. CDI has three primary goals. First, more coverage options for consumers, more insurers participating in the admitted market, and finally, fewer FAIR Plan policyholders. A combination of those three things, those three outcomes, is the best way to stabilize the insurance market. CDI aims to achieve this primarily by permitting the use of catastrophe modeling in rate making. This will allow insurers to justify rates using the probabilities of future loss rather than only hard evidence of past losses. And this should bring the asymmetry that we talked about earlier into better alignment. Insurers will be able to use the same data in setting rates and in the decisions that they make. This new flexibility comes with a trade. Insurers can use catastrophe modeling in a rate-making application only if they agree to cover at least 85% of homes in an area set by the insurance commissioner. He's promulgated lists of 28 counties and 352 zip codes for residential parcels and 1,160 zip codes for commercial parcels. Nearly all of Napa's zip codes are on both of those lists. There's one small zip code south of Oakville that includes a couple of residential parcels, UC, experimental vineyard, and commercial vineyard that's not included on the residential list. And I'm not sure why that is. That's the only omission. I think it may be because it's a newer zip code. So those lists, they have to commit to writing 85% of the policies in the high and very high fire risk areas within 2 years of the approval of that rate-making application. And they have to commit to 5% growth in the commercial market. Here, let's talk about how this applies to Napa County. Insurers are not given county-by-county targets based on these lists. They just have to pick and choose within these lists to find the mix of parcels that best suits their risk profile in order to hit that target. So this means that the counties on that list and the zip codes and localities on that list are in competition for this new business. This is where Napa's opportunity arises. Napa has put millions and millions of dollars into wildfire mitigation and continues to do so through programs like BRIC. The primary benefit, the primary return on investment to this is, of course, public safety. It's keeping the public safer from wildfires. But we have here a secondary opportunity for return on investment, which is making Napa County as attractive as we can to this new business. In turn, that will make Napa County a more appealing and more attractive place to own property and to live. And I think that's a worthwhile goal. So let's talk some numbers. Particularly residential numbers, as our time is somewhat limited. We don't know the baseline number of parcels that the insurance commissioner is going to set as that 85% target, but we can back into an estimate. In 2020, 1.4 million homes statewide were in high or very high fire hazard severity zones, according to nonpartisan nonprofit organization Next 10, which used tax assessor data to come to that number. 85% of that target is 1.12 million parcels. I think this would be the high-end estimate for what the insurance commissioner might set. It's likely he'll be more conservative, but at the very high end, we're looking at about 1.12 million parcels. Our own tax assessor puts the number of homes in high or very high fire hazard severity zones in Napa County at 4,200-ish parcels. That is about, for reference, about 10% of the parcels in the county and its cities. It makes sense for our target to be 85% of that figure. I think aiming higher would be great, but if we could meet that 85% threshold, that would be 3,600 new policies, new business in Napa County, which again would be just under 10% of our homes that would get new insurance coverage. And I think that would be that's an admirable target to plan for. This should also reduce the number of FAIR Plan policyholders in Napa County. Being a FAIR Plan policyholder and being in a very high fire hazard severity zone are not perfectly correlated, but they are highly correlated. And so in 2019, we had 252 property owners on the FAIR Plan. Currently, we have 2,277 parcels on the FAIR Plan. That's an increase of 803% in 5 years, compared to just 164% statewide. So some suggested next steps. The county has a range of operational and strategic options available to it to push for further progress in the state's insurance market. At a local level, we need to continue prioritizing investment in wildfire mitigation and engage with insurers to show them the parcel level and landscape level impacts of our investments. We also need to plan to sustain these investments over time. We don't just need to attract new business, we need to keep it. At a state level, I think we need to continue to support legislative measures that improve outcomes for consumers. In underwriting, the insurance commissioners got rate applications covered. Underwriting heretofore has not been a focus of the state government. And I think there's opportunities either through regulation of the process or through broad-scale transparency and coverage decisions to improve what consumers understand about how insurers underwrite policies. Finally, the federal government's been reluctant to weigh in on state property insurance markets with substantive legislative or regulatory action. I think it's premature right now to ask for legislation or regulatory action by the feds. We still need to see how this plays out. But Congress also possesses substantial oversight authority that it's not using through the Commerce Clause of the United States Constitution that it can use to demand data encompassing simple coverage decisions, yes or no, across state lines, that don't involve the disclosure of trade secrets. Similarly, the insurance office within the Treasury Department has opportunity to work with state insurance officials to analyze changes in regulatory policy from state to state and the resulting outcomes to recommend strategies that are proven effective. Two concluding remarks. CDI has expressed optimism that California's property insurance market is at the beginning of a period of positive change after about a decade of turmoil. At a local level, the best thing we can do is to be proactive rather than to wait and see what happens. We can position ourselves to benefit from these changes and benefit our residents and property owners by continuing to make investments in wildfire mitigation and by planning for the future investment needed for maintenance of our current efforts. Thank you.
Thank you. That was really helpful. And yes, you and I have talked about this topic a lot. And when we went back to Washington on the trip accompanying many local vintners, this was a big topic of conversation. And so, but I appreciate how you framed it here, because I think how it matters to our community and what we can do moving forward is really helpful. Are there, Supervisor Pedroza?
Thank you, Chair. Thank you, Chair, and thank you, Andrew. Look, there's a lot of information there, and I just want to challenge us. The audience it's that business owner, it's that homeowner. They either got dropped or their premium went up 25%, 30%, 50%, 100%. They're going to look at that and say, okay, what does that mean to me? So I want to challenge us. We know this. We're not the only community facing this either. But what are we going to do differently to ease that burden? And if it's legislation, then let's go 110% on it. If it's showcasing what we've done and how it's actually working, that's another story too, right? But I think people are not going to just accept, like, let's wait to see. People's affordability has dropped. Imagine your primary investment doesn't have insurance. Then you're talking to your bank, who might say, hey, you might be in default of the mortgage note, or that business has millions of dollars in inventory unsecured. Those are the real life examples of what people are facing. So I think our actions have to match that urgency. So again, I totally appreciate what you did. You covered a lot of information, which is not easy to cover. But I think we got to focus on outcomes and action. So we know this is happening, and it's going to continue to happen. So.
Thank you, Supervisor Pedroza. Supervisor Gregory.
Yeah, that was a great presentation. Good job. I love how you brought it down to the local level and gave some examples and numbers. That was good. We've seen reforms come and go before. What's the status of these proposed rules? What process is left? And how hard does local government need to advocate for ourselves?
Supervisor Gregory, I think to answer that, I need to tie together yours and Supervisor Pedroza's comments. These proposed rules are out there for public comment right now. And some of the best public comments I've seen have been that this is too much about rate making and not enough about underwriting, which the insurance commissioner currently lacks authority to do. So I think some legislative advocacy to bring the underwriting into the picture will have more immediate effect than these regulations. As to affordability, there's no easy way to say it. The likely effect of the likely immediate effect of these regulations will be that for a lot of people, their rates may go up. And this is where local governments can have the biggest impact. They're going to go up because rates have been kept artificially low up until this point. Insurers have not been able to take future risk into consideration when setting rates, and they will be now, and the future risk is not looking good. What local governments can do is we can distinguish ourselves from other counties by being proactive about our fire mitigation efforts, about our landscape level fire mitigation efforts, about the assistance that we provide to homeowners to harden their homes and to do parcel level vegetation management and to maintain that. It's not cheap to remove trees, and I think we have opportunities to help defray that cost. And even though costs of insurance on the whole, I think, are going to rise over time, we have an opportunity, I think, to buck that trend by working with insurers and engaging with insurers to show results, show that all this investment that we've been putting in has improved public safety, and that our residents deserve lower rates because of that. So to Supervisor Gregory, that would be my response to your point.
And I think I think these are both great points that my colleagues have brought up. And this question about outcomes, Supervisor Pedrosa, is like, what can we do to actually see something? And I think on the legislative front last year, we as a board supported SB 1060, which would have forced insurers to include wildfire mitigation in their underwriting. And I went to the Senate Insurance Committee to testify on that. That bill didn't pass, but I think that efforts like that are going to continue to be important. These lobbying trips to DC, I think, are important. And then we have Mr. Hsu in the room. He and I sat on a panel a couple weeks ago with insurers who are insuring local wineries, right, to really pitch how much is happening here. So I think there's a lot of things happening on the ground. I think at the end of the day, we need to show the effectiveness of all our wildfire mitigation work, how that really translates to reducing risk. So I guess that's to add to the challenges. How do we show we didn't just spend $1 million on a grazing shaded fuel break, all those things? How we need the numbers, and we need to work with our fire teams to show that actually translates into a reduced risk that insurers can kind of take to the bank, if you will. So I think that's worth noting for sure. Also, I thought that was a great presentation, and Supervisor Pedrosa, I think you got the most photos from your district in those overviews too. So, but that again, being able to link what's happening at a higher level and a policy level to what we're doing on the ground and how we can use what we're doing on the ground, because at the end of the day, it's public safety, it's insurance availability, it's reducing those fair plan numbers, because we've all heard from residents that that is just not a sustainable solution. Again, to this point about availability of insurance, I talked to a resident in Angwin who's doing a fire rebuild and then can't afford the insurance to support the rebuild. So he's in a catch-22 there. Anyway, Supervisor Pedrosa, you had another comment.
Just another comment, and I do want to give credit to the Napa Valley Vintners who put on, I think it was like a workshop, and they brought some of these insurers in. They're the audience, right? I think the insurance commissioner can do great, but it's speaking to who is talking about risk. And maybe that's an opportunity for us to engage with some of them a little bit more directly and not use a conduit to get our message out there, but to show. Because I do believe when they brought those insurance, and they were from London all over the world, and they got to see firsthand what we were doing, they go back and figure that out, right? So I think, Andrew, I think that might be an area where it can work parallel to what we're doing, right, with the lobbying efforts. But our representatives are getting asked every day from someone about something, right? So how are we different? And I think that's where I think we can differentiate ourselves a little bit. So thank you.
Yeah, absolutely. I think that's actually one of the quotes I heard from a London insurer. She said, after she heard all these examples from wineries from Dave Hsu, she said, wow, it's great to know there are smart people on the ground working on this. And we felt like, well, yeah, so sometimes it's not a report. It's actually, and I appreciate that so many of them came out here and got on the ground to see that. So thank you so much. Is there any public comment in the room on this topic or on the phones? Okay. And I see Mark Van Gorder in the audience too, and just thank you for all that PG&E is doing to try to help us reduce the risk as well. So thank you.